Hello, and welcome to our comprehensive guide on a topic that crosses the minds of many Americans each year. Filing a U.S. tax extension. The very idea of an extension can bring a mix of relief and anxiety. Is it a smart financial move, or is it just delaying the inevitable? Throughout this series, we're going to break down everything you need to know about filing for a tax extension, presented in a clear and straightforward way. We'll explore the significant advantages it can offer, as well as the potential pitfalls you'll want to avoid. Our goal is to provide you with a balanced view, so you can make an informed decision that's right for your personal financial situation. Before we dive in, it is absolutely crucial that we start with a very important disclaimer. The information provided in this series is for educational and informational purposes only. We are not providing financial, legal, or tax advice. The world of taxes is complex and constantly changing, and what works for one person may not be suitable for another. We strongly recommend that you consult with a qualified professional, such as a certified public accountant or a tax attorney, to discuss your specific circumstances. They can provide personalized advice that takes into account the details of your financial life. Think of this series as a starting point, a resource to help you understand the landscape, so you can ask the right questions when you do seek professional guidance. Your financial well-being is paramount, and professional advice is a key part of making sound decisions. So, with that in mind, let's begin our journey into the world of tax extensions. What exactly is a tax extension? In simple terms, it's a request to the Internal Revenue Service, or IRS, for more time to file your federal income tax return. In most years, the deadline to file your taxes is April 15th. If you file for an extension, you can typically push that deadline back 6 months to October 15th. It's important to immediately clear up one of the most common misconceptions about tax extensions. An extension to file is not an extension to pay. This is a critical distinction that we will come back to time and time again throughout this series because it's a point of confusion for so many taxpayers, and can lead to significant penalties and interest if misunderstood. If you owe taxes, you are still required to estimate the amount you owe and pay it by the original April 15th deadline. Filing an extension without paying what you owe will result in penalties and interest charges from the IRS, and those can add up quickly. We'll dedicate a significant portion of a future chapter to fully understanding the payment requirements and the consequences of not meeting them. For now, just remember this key takeaway. An extension gives you more time to complete your paperwork, not more time to pay the government what you owe. So, who might consider filing for a tax extension? The reasons are as varied as the taxpayers themselves. Perhaps you're a small business owner or a freelancer with a complex financial situation. You might be waiting on important tax documents, like a corrected 1099 or a Schedule K. One from a partnership or S corporation. These forms often arrive late, making it impossible to file an accurate return by the April deadline. Or maybe a significant life event has thrown a wrench in your plans. A sudden illness, a death in the family, or a natural disaster. The IRS understands that life happens, and the extension process is there to provide some much-needed breathing room during challenging times. Some taxpayers file for an extension simply because they need more time to get organized. Gathering all of your receipts, statements, and other financial documents can be a daunting task, especially if you haven't been keeping meticulous records throughout the year. Rushing to meet the April 15th deadline can lead to mistakes, missed deductions, and a lot of unnecessary stress. An extension allows you to take a step back, organize your information thoroughly, and ensure you're filing the most accurate and complete return possible. This can often lead to a better tax outcome, as you might uncover deductions or credits you would have otherwise missed in a hurry. In the chapters to come, we will delve much deeper into the specific pros and cons. We'll talk about the strategic advantages of an extension, such as having more time to fund a retirement account. We'll also walk through the potential downsides in detail, including those pesky penalties and interest we mentioned earlier. We'll break down the process of how to actually file for an extension, the forms you'll need, and the different ways you can submit your request to the IRS. We will explore special circumstances, such as being a member of the military or living abroad, which can have different rules and deadlines. We'll also discuss the psychological impact of extending your tax season. For some, it's a welcome relief. For others, it's a cloud of unfinished business hanging over their heads for another 6 months. Our aim is to arm you with knowledge. By the end of this series, you'll have a clear understanding of what a tax extension is, what it isn't, and who it's best suited for. You'll be able to weigh the benefits against the drawbacks in the context of your own financial life. You'll know how to avoid common mistakes and how to properly file for an extension if you decide it's the right move for you. The tax deadline can be a source of significant stress, but it doesn't have to be. With the right information, you can navigate your options with confidence and make choices that support your financial goals. So thank you for joining us for this first chapter. We're excited to guide you through this important topic. Welcome back. In our last chapter, we introduced the concept of a U.S. tax extension and, most importantly, clarified that it's an extension to file your paperwork, not an extension to pay any taxes you owe. Now that we have that foundational knowledge, it's time to dive into the first and perhaps most compelling reason why millions of Americans choose to file for an extension each year: the benefit of having more time. This might sound simple, but the advantages that come with this extra time are multifaceted and can have a profound impact on the accuracy of your return and your overall financial health. The primary pro of filing a tax extension is that it significantly reduces the risk of making costly mistakes. The April tax deadline can create a high-pressure environment. When you're rushing to gather documents, input numbers, and understand complex tax laws, the likelihood of errors increases dramatically. These aren't just minor typos. A simple mistake like transposing a number in your Social Security number or your bank account information can cause major headaches, leading to a rejected return or a delayed refund. Rushing can also lead to more serious financial errors, such as miscalculating your income, incorrectly claiming a dependent, or messing up the math on your deductions. These types of mistakes can trigger a notice from the IRS, which is a situation everyone wants to avoid. An extension effectively diffuses this pressure. It gives you an additional 6 months to work methodically and carefully, allowing you to double-check, or even triple-check, every line item on your return before you send it to the IRS. Beyond avoiding simple errors, the extra time is invaluable for ensuring you have all the necessary documentation. Life is rarely as neat and tidy as the tax forms suggest. You might be waiting on crucial documents from third parties that are essential for filing an accurate return. A very common example is the Schedule K-1. If you are a partner in a business, an investor in an S corporation, or a beneficiary of a trust or estate, you will receive a K-1. This form reports your share of the income, losses, deductions, and credits. The problem is, these forms are notoriously late, often arriving well after the individual tax deadline in April. Without your K-1, you simply cannot file a complete and accurate return. Filing for an extension is not just a good idea in this scenario, it's practically a necessity. Another common document delay involves corrected tax forms. You might receive a Form 1099 from a client or a financial institution, file your taxes, and then receive a corrected version in the mail a week later. This amended form could change your tax liability significantly. If you've already filed, you'll have to go through the process of filing an amended return, which is extra paperwork and potential confusion. An extension gives you a buffer, allowing more time for any corrected or delayed forms to arrive before you file, ensuring your initial submission is the correct one. This also applies to gathering your own records. Perhaps you need to track down receipts for business expenses, charitable contributions, or medical bills to see if you can itemize your deductions. The extension gives you the breathing room to do this detective work properly. This leads us to another major advantage: maximizing your tax deductions and credits. In the rush to meet the April deadline, it's incredibly easy to overlook valuable tax breaks that you are legally entitled to claim. Tax law is complicated, and there might be deductions or credits you aren't even aware of. The extra 6 months provided by an extension gives you the time to do your research. You can carefully review your financial situation from the past year. Did you pay student loan interest? Did you contribute to a traditional IRA or a health savings account? Did you have significant educational expenses? These are all areas with potential tax benefits that require careful review of the rules and your own records. By filing an extension, you create an opportunity to be a strategist rather than just a compliance filer. You can explore different scenarios. For example, the extension gives you more time to fund certain retirement accounts for the previous tax year. You have until the tax filing deadline, including extensions, to make contributions to a SEP IRA. For business owners, this can be a powerful tool for reducing your taxable income while simultaneously boosting your retirement savings. Without an extension, you would lose this opportunity after April 15th. This is a perfect example of how an extension can be a proactive financial planning tool, not just a reactive measure to a lack of time. It allows you to ensure you are not leaving any money on the table simply because you were in a hurry. Finally, having more time can be beneficial if you are working with a tax professional. Good tax preparers are incredibly busy during the peak tax season from February to April. trying to get their full attention or book a last-minute appointment can be difficult. By filing an extension, you move your tax preparation to their off-season. This often means your preparer will have more time to dedicate to your return, to answer your questions thoroughly, and to engage in thoughtful tax planning with you. They will be less rushed and less likely to overlook details that could save you money. In essence, an extension allows you to receive a higher quality of service from your chosen professional. It changes the dynamic from a frantic rush to a deliberate and careful process. In the next chapter, we will continue exploring the pros, looking at some more specific strategic advantages before we turn our attention to the potential cons. Hello and welcome back. In our last chapter, we explored how a tax extension can be a powerful tool for ensuring accuracy, gathering all your necessary documents, and maximizing your deductions and credits. We established that the extra time is invaluable for avoiding costly mistakes. Today, we're going to build on that idea and look at the extension from a different angle, not just as a defensive measure against errors, but as a proactive and strategic tool for better financial planning. This is where an extension can move from being a simple convenience to becoming an integral part of a well-thought-out financial strategy. One of the most significant strategic benefits of an extension is that it gives you more time to understand and properly account for major life events. The tax year is a 12-month period, and a lot can happen in that time. Did you get married or divorced? Did you buy or sell a home? Did you start a side business, change jobs, or receive an inheritance? Each of these events has specific and often complex tax implications. Rushing to figure everything out by April 15th can be overwhelming. An extension provides the breathing room to fully grasp the consequences and opportunities associated with these changes. Let's take the example of selling your home. The sale could result in a significant capital gain. However, there are rules that might allow you to exclude a large portion of that gain from your income. Understanding and correctly applying these rules, like the primary residence exclusion, takes time and careful documentation. With an extension, you can calmly gather your records, such as the original purchase price and the cost of any capital improvements you made over the years, to accurately calculate your cost basis and minimize your taxable gain. Rushing this process could lead you to overpay your taxes by thousands of dollars. Similarly, events like marriage or divorce fundamentally change your filing status and eligibility for various credits and deductions. An extension allows you and your tax advisor to model different scenarios and choose the most advantageous filing strategy. Another key strategic advantage lies in the ability to better coordinate with your team of financial professionals. For many people with complex finances, a tax preparer is just one piece of the puzzle. You may also work with a financial advisor, an investment manager, or an estate planning attorney. A tax return is a detailed summary of your entire financial life for the previous year. Having a nearly complete draft of this return can serve as a powerful tool for discussions with your financial advisor. By filing an extension, you can get this draft prepared and then have several months to review it with your advisor. This allows you to analyze your investment performance, your income streams, and your overall financial picture. Based on this real data, you can make more informed decisions for the current year. For instance, the tax return might highlight an opportunity for tax loss harvesting in your investment portfolio, or show that you need to adjust your withholdings to avoid a large bill next year. These strategic conversations are far more productive when they aren't rushed by an impending deadline. We touched on retirement planning in the last chapter, but it's worth revisiting from a strategic perspective. While the deadline to contribute to a traditional or Roth IRA for the previous tax year is typically the original April filing deadline, some retirement plans, like a SEP IRA or a solo 401k for self-employed individuals, allow you to make contributions for the previous year up until your extended filing deadline. This is a game changer. It means you can see your finalized business income on your tax return, and then decide on the exact amount you want to contribute to your retirement account to optimize both your tax savings and your long-term financial goals. This is a direct, tangible financial benefit that is only possible if you file for an extension. It turns a compliance task into a wealth-building opportunity. Finally, let's consider the psychological benefit of turning tax time into a more orderly process. Financial stress is a major issue for many people, and a looming tax deadline is a significant contributor. For some, the anxiety isn't just about finding the time, it's about the fear of the unknown. How much will I owe? Did I do everything right? By filing an extension, you are taking control of the timeline. You are consciously deciding to trade the pressure of the April deadline for a more manageable process over the summer. This allows you to approach your taxes with a clear head, which almost always leads to better outcomes. Of course, as we must always reiterate, this strategy only works if you properly estimate and pay any taxes you owe by the original April 15th deadline. Failing to do so will negate many of these benefits. In our next chapter, we will pivot and begin to explore the other side of the coin. While an extension can be a fantastic tool, it is not without its potential drawbacks. We will start to unpack the cons, beginning with the single most misunderstood and financially damaging aspect of filing for a tax extension. Welcome back to our series. In the last few chapters, we focused exclusively on the benefits of filing for a tax extension. More time for accuracy, strategic planning, and peace of mind. But now, we must turn our attention to the other side of the equation: the potential drawbacks and risks. This brings us to the single most critical piece of information in this entire series. A point so important that it can be the difference between a smooth tax season and a financial nightmare. This is the ultimate con of a tax extension. An extension of time to file your return is absolutely, unequivocally, not an extension of time to pay the taxes you owe. Let's repeat that, because it is the foundation of every risk associated with an extension. You are granted more time to complete your paperwork, but the due date for your tax payment remains the same. For most taxpayers, that date is April 15th. If you owe the government money and you don't pay that amount by the original deadline, the IRS will begin charging penalties and interest, regardless of whether you have filed for an extension. These charges start accruing the very next day, on April 16th, and they will continue to build until the full amount is paid. This is a trap that many well-intentioned taxpayers fall into, assuming that the 6-month extension applies to everything. It does not. So, how does this work in practice? When you file for an extension, you are required to make a reasonable, good-faith estimate of your total tax liability for the year. Then, you must pay that estimated amount along with your extension request by the April deadline. This is where the process can get tricky. How do you estimate what you owe if you don't have all your documents ready? For many, this involves using your previous year's tax return as a guide and adjusting for any known changes in income or deductions. Modern tax software can also be a huge help, as you can input the information you do have to get a preliminary calculation. The key is to make an honest and reasonable effort. A wild guess that is significantly lower than what you ultimately owe could be viewed by the IRS as an invalid extension request, potentially leading to even more penalties. Now let's talk about those penalties and interest, because this is where the real financial damage can occur. If you don't pay your taxes by the due date, the IRS will typically assess a failure to pay penalty. This penalty is generally calculated as a percentage of the unpaid taxes for each month or part of a month that the taxes remain unpaid. The current rate, as stated by the IRS, is 0.5% of the unpaid tax, but this can increase, and it is capped at a maximum of 25% of your unpaid tax bill. While 0.5% per month might not sound like a lot, it adds up steadily over the 6 months of your extension. But that's not all. In addition to the penalty, the IRS also charges interest on the underpayment. Interest is charged on the unpaid tax, on the penalties themselves, and it compounds daily. The interest rate is based on the federal short-term rate and can change quarterly. Think about that for a moment. You are being charged interest on the penalties that are being charged for not paying the tax. This can create a snowball effect, where the amount you owe grows faster than you might expect. The purpose of this system is to strongly incentivize taxpayers to pay on time, and it is a powerful incentive indeed. It's also important to understand another penalty: the failure to file penalty. This penalty is much harsher. It's typically 5% of the unpaid taxes for each month or part of a month that a return is late, also capped at 25%. Now you might be thinking, but I filed an extension, so this won't apply to me. And you are correct, as long as your extension is valid and you file by the extended deadline of October 15th. This highlights a crucial piece of advice. Even if you know you cannot pay your full tax bill by April 15th, you should still always file for an extension. Filing an extension protects you from the much larger failure to file penalty. The failure to pay penalty will still apply to any unpaid balance, but you will have avoided the more severe penalty. To put it simply, the biggest con of an extension is that it creates a two-step process that can be easy to misunderstand. It requires you to accurately estimate and pay your liability without having a completed return. If your estimate is too low, or if you are unable to pay the estimated amount, you will find yourself in a costly situation. In our next chapter, we will discuss another major con: the simple fact that an extension can lead to procrastination, leaving a major financial task hanging over your head for half the year. Hello and welcome back. In our last chapter, we confronted the most significant financial pitfall of filing a tax extension: the fact that you still must pay your estimated taxes by the original April deadline to avoid penalties and interest. Now we're going to move from the hard numbers to the softer, yet equally important, cons of an extension. We'll be talking about the human element, specifically, the problem of procrastination, and the very tangible consequence of delaying any refund you might be owed. For many people, the primary appeal of a tax extension is the immediate sense of relief it provides. The pressure of the April 15th deadline vanishes, and the task of filing taxes gets pushed into the future. While this feels good in the moment, it can create a psychological trap. The extension can foster an out-of-sight, out-of-mind mentality. However, the task hasn't actually been completed. It has merely been deferred. This can lead to a low-grade, persistent stress that hums in the background of your life for the next 6 months. Instead of having your financial slate wiped clean in April, the unfinished business of your tax return lingers through the summer and into the fall. Many people find this mental burden to be a significant downside, as it prevents them from achieving a sense of financial closure for the previous year. Beyond the mental weight, procrastination introduces practical problems. The passage of time can be an enemy of good record-keeping. The longer you wait to organize your tax documents, the higher the likelihood that a crucial receipt, a bank statement, or a record of a charitable donation gets lost or misplaced. Your memory also fades. A particular business expense from last March might be easy to recall in April, but by September, you may struggle to remember the specific details, potentially causing you to miss out on a legitimate deduction. Delaying the process can turn a manageable task into a frantic archaeological dig for documents and details. Furthermore, life doesn't stop just because you've extended your tax deadline. The extra time you think you're getting can be quickly consumed by other priorities. Summer vacations, family events, work projects, and back-to-school preparations can all fill up your calendar. Before you know it, it's late September, and you're facing the October 15th deadline with the same sense of pressure you were trying to avoid in April. This can lead to a second rush to get your taxes done, which defeats the entire purpose of filing for an extension in the first place and reintroduces the risk of making mistakes. Perhaps the most concrete and financially impactful downside for many taxpayers is what an extension does to a tax refund. If you are due a refund from the IRS, you cannot receive that money until you have filed your tax return. By filing an extension, you are voluntarily delaying access to your own money. In effect, you are giving the U.S. government an interest-free loan for up to 6 additional months. That refund money could be put to much better use in your own hands. It could be used to pay down high-interest debt, such as a credit card balance. It could be added to your emergency fund, invested for the future, or used for a necessary purchase. Think about it this way. If you are owed a $2,000 refund, every month you delay filing is a month that money is not working for you. In a high-interest savings account, it could be earning you money. If used to pay off a credit card with a 20% interest rate, it could be saving you a significant amount in interest charges. Delaying your refund directly impacts your personal cash flow and can represent a real, albeit indirect, cost. For this reason, if you are confident that you will be receiving a refund, it is almost always in your best interest to file your return as soon as possible, rather than seeking an extension. In our next chapter, we'll continue exploring the cons by looking at how an unfiled tax return can complicate other areas of your financial life, such as applying for a loan or mortgage. Welcome back. In our previous chapter, we discussed the internal challenges that come with a tax extension, the psychological weight of procrastination, and the financial cost of a delayed refund. Today, we're shifting our focus to the external challenges. We will explore how an unfiled tax return, even one that is properly extended, can create significant hurdles in other areas of your financial life, particularly when you need to prove your income for a loan, a mortgage, or even for student financial aid. For lenders and financial institutions, your filed tax return is the gold standard for income verification. It is an official document submitted to the U.S. government, providing a detailed and legally affirmed picture of your financial situation for the year. When you apply for a major loan, especially a mortgage, underwriters rely heavily on your tax returns to assess your ability to repay the debt. They typically want to see a stable and predictable income stream, and your tax returns are the primary evidence they use to confirm it. This is especially true if you are self-employed, a freelancer, a small business owner, or have significant income from sources other than a single employer's W-2. Now imagine you are in the process of buying a home. The mortgage application process is notoriously rigorous. Lenders will almost always require you to provide copies of your 2 most recently filed federal tax returns. If you are applying for a mortgage anytime between April and October, and have filed for an extension, you have a problem. You cannot provide the tax return for the most recent year, because you haven't filed it yet. This can throw a major wrench into the underwriting process. While it may not result in an automatic denial, it creates a significant complication. The lender's underwriting team will have to work with incomplete information. They might try to base their decision on your older tax return, but that might not accurately reflect your current, and hopefully higher, income. They will likely ask for a substantial amount of additional documentation to compensate for the missing return. This could include a year-to-date profit and loss statement for your business, copies of recent bank statements, and other financial records. This not only adds to your paperwork burden, but can also cause serious delays in the loan approval process. In a competitive housing market where closing dates are critical, such delays can be incredibly stressful and could even jeopardize the purchase of your home. The lender is taking on more risk by approving a loan without that finalized tax return, and this can make the entire process more difficult for you as the borrower. The same issue can arise in other lending situations. If you're a small business owner applying for a business loan, the bank will want to see your most recent business tax returns. An extension signals that your books for the previous year are not yet closed, which can raise questions for a loan officer. Even for personal loans, an unfiled tax return presents an incomplete financial picture that can make a lender hesitate. This challenge also extends to the world of higher education. When applying for federal student aid using the free application for federal student aid, commonly known as the FAFSA, you are required to provide income and tax information. While the FAFSA system often uses tax data from the prior year, there are many situations where a family's financial circumstances have changed, and they need to provide more current information to the school's financial aid office. If you are trying to appeal a financial aid package based on a recent drop in income, the financial aid office will want to see your most recent tax return to verify that change. If you have filed an extension, you won't have that crucial document, which can delay or complicate your ability to secure the financial aid your student needs. In all these scenarios, the core issue is the same. A filed tax return is a definitive, official document. An extension, while perfectly legal, leaves your most recent financial year in an unverified state. While you can provide lenders with a copy of your extension form, Form 4868, it doesn't verify your income. It only proves that you've requested more time to file. This distinction is critical. In our next chapter, we will discuss another practical complication: how a federal tax extension interacts with your state tax obligations. Welcome back. Thus far in our exploration of the cons of filing a tax extension, we've covered the critical payment requirement, the pitfalls of procrastination, and the complications with loan applications. Today, we address another major practical challenge that is often overlooked: the relationship between your federal tax return and your state tax return. Navigating this connection incorrectly can lead to unexpected penalties and a lot of frustration. Here is the essential fact you need to know. A federal tax extension does not automatically grant you an extension to file your state taxes in every state. This is a common and dangerous misconception. While you might have successfully requested 6 more months to file with the IRS, your state's tax agency may have entirely different rules and requirements. Forgetting about your state tax obligations can result in a failure to file penalty at the state level, even if you've done everything right on the federal side. Generally speaking, states fall into a few different categories when it comes to extensions, and it is absolutely vital that you understand which category your state belongs to. Please remember, state tax laws can change, so you must always verify the current rules with your state's official Department of Revenue or a qualified local tax professional. The first group of states offers what is often called an automatic or piggyback extension. In these states, if you have filed a valid federal extension with the IRS, your state will automatically honor it and grant you a similar 6-month extension for your state return. You may not need to file any additional paperwork with the state. This is the most convenient scenario, but you still need to be certain that your state operates this way. The second group of states requires you to take a separate action. These states do not automatically accept a federal extension. You must file a specific state extension form directly with the state's tax agency by the state's original filing deadline. This form is completely separate from the federal Form 4868. If you file a federal extension but forget to file the required state extension form, you will be considered late by the state and will likely face penalties. Then, of course, there are a handful of states that do not have a state income tax at all. in which case this particular issue would not apply to you. But for the vast majority of Americans, this federal and state relationship is a critical piece of the tax puzzle.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Furthermore, and this should sound familiar by now, an extension to file your state taxes is not an extension to pay your state taxes. Just like the IRS, state tax agencies want their money by the original deadline. You must make a good faith estimate of the state tax you owe and pay that amount on time. This creates another layer of complexity. Many state tax returns use your federal adjusted gross income, or AGI, as their starting point. If you haven't completed your federal return, you can't be certain what your federal AGI is. This makes it very difficult to accurately calculate the state tax you owe, turning your required state payment into a challenging estimation game. An incorrect estimate can lead to underpayment, resulting in state-level penalties and interest on top of any you might already owe to the IRS. In essence, filing a federal extension can create a domino effect. It complicates not only your federal tax payment, but also your state filing requirements and your state tax payment. It requires you to be twice as diligent, managing two separate but related sets of rules and deadlines. In our next chapter, we will wrap up our discussion of the pros and cons, and move into the practical how-to of the extension process. Hello and welcome back. Over the last 7 chapters, we have thoroughly weighed the pros and cons of filing for a U.S. tax extension. We've discussed the strategic advantages, like gaining more time for accuracy and planning, as well as the significant drawbacks, such as the requirement to pay on time and the potential for procrastination. Now we're shifting from the why to the how. For the next few chapters, we will walk you through the practical, step-by-step process of actually filing for an extension. Before we begin, a crucial disclaimer. The methods and forms we discuss are based on current IRS procedures. The IRS can and does update its forms and processes, so you must always refer to the official IRS website at irs.gov for the most up-to-date information, forms, and instructions. This is your single most reliable source. The official form for requesting an extension for your personal income taxes is Form 4868, titled Application for Automatic Extension of Time to File U.S. Individual Income Tax Return. The key word here is automatic. As long as you file this form correctly and by the original tax deadline, the IRS automatically grants you a 6-month extension to file your return. You do not need to provide a reason or an excuse. The process is designed to be straightforward. Today there are several ways to file Form 4868, and the vast majority of them are electronic. The IRS strongly encourages electronic filing as it is the fastest, most secure, and most accurate method. In fact, some of the easiest ways to get an extension don't even involve filling out a virtual form at all. The simplest method for most people is to get an extension by making a payment. If you have estimated your tax liability for the year, as we discussed in Chapter 4, you can file your extension and make your payment in a single, easy step. The best way to do this is by using IRS Direct Pay, which is a free and secure service on the IRS website. Using Direct Pay, you can transfer money directly from a checking or savings account. During the process, you will be asked to select the reason for your payment. You would simply choose Extension from the menu. By making a payment and designating it as being for an extension, you automatically get your extension to file. There is no need to fill out or mail a separate Form 4868. It's an all-in-one process. Similarly, you can pay using a debit card, credit card, or a digital wallet through one of the IRS's third-party payment processors. You can find links to these approved processors on the IRS website. When you make a payment this way, you will again indicate that the payment is for a tax extension. This will also automatically file your extension for you. It's important to be aware that these third-party services typically charge a processing fee for their services, unlike IRS Direct Pay, which is free. Another extremely common electronic method is to use tax preparation software. Whether you use a major online tax software brand or a downloadable desktop program, they all support filing for an extension. The software will typically guide you through a simple interview process, asking for your basic personal information and your estimated tax liability. It will then populate Form 4868 for you and allow you to e-file it directly with the IRS. In many cases, tax software companies offer the ability to e-file an extension for free, even if you later choose to pay to file your full return. This is an excellent, user-friendly option for those who are already comfortable using tax software. Finally, if you work with a tax professional, such as a certified public accountant or an enrolled agent, they can file an extension on your behalf. You simply need to provide them with the necessary information to estimate your tax liability, and they will handle the e-filing process for you as part of their services. In our next chapter, we will discuss the more traditional method, how to complete and mail a paper copy of Form 4868, for those who prefer not to handle their tax matters electronically. Welcome back. In our last chapter, we walked through the modern, electronic ways to file for a tax extension, which are the fastest and most recommended methods. However, we understand that some individuals may prefer, or need, to file using the traditional paper method. So today, we are going to cover the step-by-step process for completing and mailing a paper Form 4868. While this method is less common now, it is still a valid way to request an extension, and it's crucial to do it correctly to ensure it's accepted by the IRS. The first step is to get the correct form. You should always download the latest version of Form 4868 directly from the official IRS website at irs.gov. Simply use the search bar on their site to look for Form 4868. This will ensure you have the correct form for the current tax year, along with the official instructions. The instruction booklet is just as important as the form itself, as it contains critical details like the correct mailing address. Once you have the form, you'll see it is relatively short and divided into two main parts. Part 1 is for your identification. You will need to fill in your name, address, and social security number. If you are filing a joint return with a spouse, you will need to include their name and social security number as well. It is absolutely essential that this information is written clearly, and that it exactly matches the information the Social Security Administration has on file for you. A mismatch in names or numbers is a common reason for a form to be rejected. Part 2 is where you will calculate your estimated tax. This section requires 3 key numbers. First, you'll enter your estimate of your total tax liability for the entire year. Second, you'll enter the total amount of payments you have already made for that tax year. This would include federal income tax withheld from your paychecks, as shown on your W-2s, and any estimated tax payments you made throughout the year. Finally, you subtract your total payments from your total liability to find the balance due. If the result shows you have overpaid, you can leave the balance due line blank. If you owe money, this is the amount you should pay along with your extension form. If you do have a balance due, you must include a payment. You should send a check or money order. Never send cash through the mail. Make your check or money order payable to the U.S. Treasury. This is a very specific instruction. On the memo line of your check, you must write your social security number, the tax year for which you are filing the extension, and the words Form 4868. This information is vital as it ensures the IRS properly credits the payment to your account and for the correct purpose. Also, a practical tip: do not staple or paperclip your check to the form. Simply enclose it in the envelope. The next critical step is mailing it to the correct address. The mailing address for Form 4868 depends on 2 factors: the state you live in and whether or not you are including a payment. The instructions for Form 4868 will have a chart listing all the correct mailing addresses. You must look up the correct address for your specific situation. Sending it to the wrong IRS office can cause significant delays and could result in your form being considered late. Finally, and this is perhaps the most important point of caution for paper filing, you must be able to prove that you mailed it on time. The envelope must be postmarked by the original tax deadline, typically April 15th. We strongly recommend that you send the form using USPS certified mail, with the return receipt requested. This will cost a few extra dollars, but it is well worth it. Certified mail provides you with a mailing receipt that is postmarked with the date, which is your legal proof of timely filing. The return receipt will be mailed back to you with a signature, proving the IRS received your form. If your extension were to ever be lost in the mail, this receipt would be your essential evidence to avoid a failure to file penalty. In our next chapter, we'll discuss special circumstances that can affect your tax filing deadline, such as being a member of the military or living outside the United States. Welcome back. In our last few chapters, we've detailed the standard process for filing a tax extension, which for most people involves submitting a request by the April 15th deadline. Today, we're going to discuss a major exception to that rule. The IRS has special provisions for certain taxpayers who are not within the United States on tax day. This chapter is dedicated to U.S. citizens and resident aliens who are living and working abroad. It's crucial to understand these rules, as they are significantly different from the standard extension process. The most important rule for taxpayers abroad is the automatic 2-month extension. If you are a U.S. citizen or resident alien, and your main place of business or post of duty is outside the United States and Puerto Rico on the regular due date of your return, you receive an automatic extension to file your return until June 15th. This also applies if you are in the military or naval service on duty outside the U.S. and Puerto Rico. Let's break down what automatic means in this context. It means you do not have to file Form 4868 or any other form to get this initial extension. It is granted to you by the IRS simply for meeting the criteria of being abroad. However, when you do file your return, you must attach a statement to it explaining that you qualified for this extension because you were living and working outside the U.S. on the tax deadline. Here is the most significant difference and benefit for this group. This automatic 2-month extension is an extension to both file and pay. This is a critical exception to the rule we've emphasized throughout this series. While taxpayers in the U.S. must pay by April 15th to avoid penalties and interest, those who qualify for this automatic extension have until June 15th to pay any tax they owe without incurring a failure to pay penalty or interest charges. This gives expats and others working abroad valuable extra time to sort out their finances, which can often be more complex due to foreign income and currency conversions. But what if you need more time beyond the June 15th deadline? Many people do, especially if they are waiting for documents related to foreign income, or need to qualify for certain foreign tax credits or exclusions. In this case, you can request a further extension to the standard October 15th deadline. To do this, you must file Form 4868 by the automatic extension deadline of June 15th. This will give you an additional 4 months to complete your paperwork, for a total of 6 months from the original April deadline. However, and this is a very important point, the special extension to pay ends on June 15th. If you file Form 4868 to extend your filing deadline to October 15th, you must pay your estimated tax liability by the June 15th date. If you do not, the failure to pay penalty and interest will begin to accrue from June 16th onward on any unpaid balance. So the first 2 months are a grace period for both filing and paying, but any extension after that reverts to the standard rule. It is an extension to file, not an extension to pay. Understanding this 2-tiered extension system is essential for U.S. taxpayers living abroad to remain in good standing with the IRS. For more detailed information, the definitive resource is IRS Publication 54, Tax Guide for U.S. Citizens and Resident Aliens Abroad, which can be found on the IRS website. In our next chapter, we will discuss another group with special rules: members of the U.S. military, particularly those serving in combat zones. Welcome back. In our previous chapter, we explored the special tax extension rules for U.S. citizens living and working abroad. Today, we turn our attention to another group that receives unique consideration from the IRS due to their service and sacrifice: the members of the United States Armed Forces. The tax code includes several important provisions designed to ease the burden of tax compliance for military personnel, especially for those serving in harm's way. The most significant of these provisions applies to service members who are serving in an area designated as a combat zone. It's important to understand that a combat zone is an official designation made by the President of the United States through an executive order. These are areas where the armed forces are engaging in combat. The IRS keeps an updated list of these designated zones. For the most current and detailed information, service members and their families should always consult IRS Publication 3, the Armed Forces Tax Guide. This is the definitive resource for all military-related tax matters. For those serving in a designated combat zone, the deadline for virtually all tax-related actions is automatically extended. This is the most comprehensive extension the IRS offers. It covers not just filing your tax return, but also paying any taxes you owe, filing a claim for a refund, making a contribution to an IRA, and responding to IRS notices. This means that during the extension period, no interest or penalties will be charged. So how long is this automatic extension? The deadline is extended for the entire time you are serving in the combat zone, plus an additional 180 days after you leave the combat zone. Let me repeat that, as it is a powerful benefit. Your deadline is paused while you are there, and does not restart until you have been out of the zone for 180 days. For example, if you had 30 days left to file your taxes when you were deployed to a combat zone, you would have those 30 days, plus the 180 days, after your service in the zone ends to take care of your tax obligations. This also applies if a service member is hospitalized due to an injury received while serving in a combat zone. This extension is automatic. If you are serving in a combat zone, you do not need to file Form 4868 or take any action to request this extension. The Department of Defense typically notifies the IRS of service members who are serving in these areas. This provision is also broad in who it covers. It applies to members of the Army, Navy, Marine Corps, Air Force, and Coast Guard. In many cases, it also applies to the service member's spouse, particularly if they file a joint return. It's also worth noting that these rules can apply to individuals serving in what are called contingency operations, as designated by the Secretary of Defense. Again, Publication 3 provides the specific details on which operations qualify. The core principle behind these rules is simple. A service member focused on a mission in a combat zone should not also have to worry about a tax deadline back home. The tax system is designed to give them ample time to readjust and handle their financial affairs after their service in the zone is complete. In our next chapter, we will begin to wrap up our series by summarizing the key decision points you should consider when deciding whether a tax extension is the right choice for your specific situation. We will create a checklist of questions to ask yourself before you file. Welcome back. Over the course of this series, we have taken a deep dive into the world of U.S. tax extensions. We've explored the significant pros, the serious cons, and the specific procedures for filing. Now it's time to bring all of that information together to help you make a final decision. In this chapter, we've created a decision checklist, a series of simple but powerful questions to ask yourself. By answering them honestly, you can gain clarity on whether an extension is a wise strategic move or an unnecessary risk for your personal situation. As always, this is for educational purposes and is not a substitute for professional tax advice. First question: why am I truly considering an extension? Be honest with yourself. Is it because you are waiting for a crucial document, like a Schedule K, one from a partnership? Or did you have a complex financial event this year, like selling a business, that requires careful work to report accurately? These are excellent reasons to seek an extension. However, if your primary reason is simply that you haven't gotten around to it and want to put it off, you might be falling into the procrastination trap we discussed earlier. An extension to ensure accuracy is a strategy. An extension to delay the inevitable is just prolonging the stress. Welcome back. As we approach the end of our series, we want to take some time to address some of the most common questions and myths that surround the topic of filing a tax extension. Think of this chapter as a rapid-fire Q&A session, designed to clarify any lingering points of confusion and reinforce some of the key lessons we've learned so far. Our first and most frequently asked question is: does filing a tax extension increase my chances of being audited by the IRS? This is a persistent myth, and the answer is a clear no. The IRS itself has stated that the selection of a return for an audit is not based on whether the taxpayer filed an extension. Audit selection is a complex process based on a variety of factors, such as computer scoring that looks for anomalies or discrepancies when compared to similar returns. Things that might trigger an audit include unusually high deductions for your income level, failing to report all your income, or claiming significant business losses. The decision is based on the content of your return, not the timing of its submission. Filing an extension to ensure your return is accurate and complete may actually reduce your risk of an audit, as a rushed, error-filled return is more likely to contain the types of red flags that attract IRS attention. Second question: what happens if I file an extension but then miss the October 15th deadline? This is a critical point to understand. The 6-month extension is a one-time offer. There are no further extensions beyond October 15th for most taxpayers. If you fail to file your return by the extended deadline, the significant failure to file penalty will be applied. This penalty is much harsher than the failure to pay penalty, and it will be calculated starting from the day after your extended due date. Furthermore, any penalties for failing to pay and interest on your unpaid balance would have been accumulating since the original April 15th deadline. Missing the October deadline puts you in a serious non-compliance situation with the IRS, so it is essential to treat October 15th as a firm, final deadline. Third question: I've realized I can't pay the full amount I owe by the deadline. What should I do? This is a stressful situation for many people, but ignoring it is the worst possible response. First, you should still file for an extension and file your return on time. This prevents the costly failure to file penalty. Second, you should pay as much as you possibly can by the April 15th deadline. The penalties and interest are calculated on the unpaid balance, so any amount you can pay will reduce the total cost. The IRS has several payment options available for taxpayers who cannot pay their bill in full. These can include a short-term payment plan, which may give you up to 180 additional days to pay, or a more formal, offer in compromise, or installment agreement for those with more significant financial hardship. You should immediately visit the IRS.gov website to learn about these payment plans or consult with a credentialed tax professional. The key is to be proactive and communicate with the IRS. Final question for this chapter. Can I cancel a tax extension once I've filed it? There isn't really a need to cancel an extension. The extension simply gives you permission to file later. It doesn't obligate you to wait until October. You can and should file your tax return as soon as it is ready and accurate. If you file an extension in March, but have all your documents ready by May, you can file your return in May. The extension just sets the final possible due date. It doesn't change your ability to file at any point before that date. In our next chapter, we will begin to bring our series to a close with a final summary of key takeaways and some concluding thoughts. Welcome back. You've successfully filed for a tax extension. A wave of relief washes over you as the April 15th deadline passes without the stress of a last-minute filing. You now have until October 15th to complete your return. But what happens now? The greatest danger of an extension is treating it as a 6-month pass to forget about your taxes entirely. To truly benefit from an extension, you must treat this period not as a delay, but as an opportunity. This chapter is your guide to making the most of that extra time. First and foremost, do not wait until October. The October 15th deadline will arrive much faster than you think. The most effective thing you can do is to set your own earlier deadline. Look at your calendar and pick a date, perhaps August 15th or September 1st, and commit to it as your personal tax completion day. This creates a manageable timeline and reinstates a sense of urgency, preventing the same last-minute panic you sought to avoid in April. Write this new deadline down and treat it as seriously as you would the official one. Second, get organized immediately. You likely filed for an extension because you were missing information. Create a dedicated tax documents folder, either physical or digital. Make a checklist of every single document you are waiting for. The corrected 1099, the Schedule K-1, the final brokerage statement. As each document arrives in the mail or your inbox, check it off the list and place it directly into your folder. Don't let it sit on a countertop or get lost in a sea of other emails. This simple system ensures that when you are ready to work on your return, everything you need is in one place. Third, schedule time to work on your taxes. Just like any important project, doing your taxes won't happen unless you make time for it. Block out specific periods on your calendar. It could be 2 hours every other Sunday or the first Saturday of each month. Use this scheduled time to review the documents you've received, organize receipts, and update your preliminary tax calculations. By chipping away at the task over time, you make it far less intimidating than trying to tackle it all in one marathon session in October. Fourth, as you gather your final documents, reevaluate your tax payment. Remember, the payment you made in April was an estimate. As your final income and deduction numbers become clear, you might find that your initial estimate was too low. If you realize you are going to owe significantly more than you originally paid, it is wise to consider making an additional payment to the IRS as soon as you know. The failure to pay penalty and interest are calculated on the unpaid balance, and they accrue from April. Sending another payment in July or August can significantly reduce the total amount of penalties and interest you will ultimately owe. Finally, use this time for proactive financial planning. As you finalize last year's tax return, you have a perfect, detailed snapshot of your financial life. Use this to inform your decisions for the current tax year. Did you end up with a huge, unexpected tax bill? Now is the perfect time to adjust your W-4 withholdings with your employer, or to set up a plan for making quarterly estimated payments. Did you struggle to find receipts for business expenses? Now is the time to implement a better record-keeping system for this year. By using your completed return as a planning tool, you turn a reactive chore into a forward-looking strategy. In our final chapter, we will conclude our series with a summary of the most important takeaways and offer some final thoughts on navigating the U.S. tax system with confidence. And so, we arrive at the final chapter of our comprehensive guide, Filing a U.S. Tax Extension, the ultimate pros and cons list. We want to thank you for joining us on this journey. Our goal from the very beginning was to demystify the tax extension process, to arm you with balanced, clear information so you can navigate your financial responsibilities with confidence. To conclude, we're going to summarize the most critical takeaways, the essential truths you should remember long after this audio has ended. First, and above all else, is the golden rule we have repeated in nearly every chapter. An extension of time to file is not an extension of time to pay. If you walk away with only one piece of information from this series, this is it. You must make a good faith estimate of your tax liability and pay that amount by the original April deadline to avoid the steady accumulation of penalties and interest. Understanding this distinction is the key to using an extension successfully. Our second key takeaway is that a tax extension, when used correctly, is a powerful strategic tool for ensuring accuracy and completeness. It is not a sign of failure or disorganization. Rather, it is a smart move for those who are waiting on important documents like a Schedule K, 1, dealing with a complex financial event from the past year, or who simply need more time to ensure they claim every single deduction and credit they are legally entitled to. A rushed return is an error-prone return. An extension buys you the time to be diligent. Third, you must respect the downsides. Beyond the payment requirement, remember the practical and psychological cons. An extension can foster procrastination, leaving a significant financial task hanging over your head for 6 extra months. If you are due a refund, you are giving the government an interest-free loan. And an unfiled return can create very real complications if you need to apply for a mortgage or other forms of credit. A wise decision involves weighing the strategic benefits against these tangible drawbacks. Fourth, the filing process itself is straightforward. For most people, the simplest and most secure way to get an extension is to file electronically, and the easiest way to do that is by making your estimated tax payment directly through the IRS website. Always use the official irs.gov as your source for forms, payment portals, and instructions. Finally, remember that the tax system makes accommodations for those in unique situations. We learned about the special automatic extensions for U.S. citizens living abroad, and the comprehensive protections offered to our military service members serving in combat zones. If you fall into one of these categories, be sure to consult the specific IRS publications that apply to you. Ultimately, managing your taxes is a fundamental part of managing your financial health. A tax extension is just one of many tools available to you. By understanding how it works, you can make an informed choice that best suits your circumstances. We hope this series has empowered you to approach tax season not with fear or anxiety, but with knowledge and a plan. Thank you again for listening. We must conclude with one final, essential reminder. The information provided in this series has been for educational and informational purposes only. It is not financial, legal, or tax advice. We strongly encourage you to consult with a qualified and credentialed professional to address your specific financial situation. Welcome back. Throughout this series, we have covered the pros, cons, and procedures of filing for a tax extension. Now we want to dedicate a chapter to the most common pitfalls, the simple but costly mistakes that taxpayers often make in this process. By understanding these errors ahead of time, you can navigate your extension with confidence and avoid unnecessary stress and financial penalties. The first and by far the most significant mistake is assuming the extension to file is also an extension to pay. We have mentioned this before, but it is so critical it must be at the top of this list. Many taxpayers successfully file Form 4868, breathe a sigh of relief, and then do nothing until October. This is a major error. The IRS requires you to estimate your tax liability and pay that amount by the original April 15th deadline. If you fail to do so, penalties and interest on the unpaid amount will begin to accrue immediately. This is not a gray area. It is the fundamental rule of tax extensions. Ignoring it is the fastest way to turn a helpful tool into a costly problem. The second mistake is closely related, making an unreasonable or bad faith estimate of your taxes. The IRS requires a reasonable estimate of your tax liability on Form 4868. This means you must make a genuine effort to figure out what you will likely owe. Simply putting zero or a ridiculously low number without any basis could lead the IRS to invalidate your extension. If your extension is deemed invalid, the IRS will treat you as if you never filed one at all, which could expose you to the severe failure to file penalty. A good faith effort involves looking at your prior year's tax return, considering any changes to your income and deductions for the current year, and using the information you do have to make an educated calculation.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
The third common mistake is completely forgetting about your state taxes. As we discussed in a previous chapter, your tax obligations don't end with the IRS. Most states have their own income tax, and their rules for extensions can be very different from the federal rules. Some states accept a federal extension automatically, but many others require you to file a separate state-specific extension form. Furthermore, you must also pay your estimated state tax liability by your state's original deadline. Forgetting this step can lead to penalties and interest from your state's Department of Revenue, even if you've handled everything perfectly on the federal level. Always check your state's specific rules. Our fourth mistake is treating the extension as a license to procrastinate, and then missing the October 15th deadline. Filing an extension should be an active strategy, not a passive delay. It's easy to push the task to the back of your mind during the busy summer months. However, the October 15th deadline is firm. There are no further extensions. Missing this final deadline will trigger the failure to file penalty, which is far more severe than the failure to pay penalty. As we discussed in a previous chapter, you should set your own earlier deadline and schedule time to work on your return throughout the extension period to avoid a last-minute scramble in the fall. Finally, the fifth mistake is poor record-keeping during the 6-month extension period. Often, the reason for an extension is to gather more documents. The mistake is not actively pursuing and organizing those documents. The longer you wait, the more likely you are to misplace a receipt or forget the details of a particular business expense. Use the extra time to create a dedicated folder, follow up on missing K-1s or 1099s, and organize your records. Good organization not only makes filing easier, but also ensures you don't miss out on valuable deductions. By avoiding these 5 common mistakes, you can ensure that your tax extension serves its intended purpose: to provide you with the time to file a complete, accurate, and stress-free return. In our next chapter, we will focus on the specific needs of a group with often complex tax situations: freelancers, contractors, and small business owners. Welcome back. In this chapter, we're going to focus on a group of taxpayers whose financial lives are often more complex than a typical W-2 employee: the self-employed. This includes freelancers, independent contractors, gig workers, and small business owners. For these individuals, a tax extension is often not just a convenience, but a near necessity for accurate and strategic tax filing. If you are self-employed, you know that your bookkeeping is a year-round task. Unlike a salaried employee who receives a single W-2, you may have dozens or even hundreds of income sources. You also have a wide range of business expenses to categorize and deduct. Properly tallying a full year of income, tracking every deductible expense, and reconciling your bank statements takes a significant amount of time. An extension provides the crucial breathing room to perform this accounting work diligently, ensuring you don't miss any legitimate deductions that could save you thousands of dollars. Furthermore, the self-employed often rely on tax documents from clients, namely Form 1099 NEC. While these are supposed to be sent by January 31st, they often arrive late, or you may receive a corrected version weeks later. An extension provides a buffer for these documents to arrive, preventing the need to file an amended return. For this group, the rule about paying your estimated taxes by April 15th is doubly important. Since you don't have an employer withholding taxes from each paycheck, you are responsible for paying your own taxes throughout the year via quarterly estimated payments. Your April 15th payment is your final chance to true up these payments against your actual income for the year. A careful, well-documented estimate is critical to avoid a substantial underpayment penalty. However, the most powerful reason for a self-employed person to file an extension is for the strategic retirement planning opportunities it unlocks. Certain small business retirement plans, most notably the SEP IRA and the Solo 401k, have a unique contribution deadline. You can make contributions for the previous tax year all the way up until your tax filing deadline, including extensions. This is a massive advantage. It means you can complete your tax return in July or August, see your final net self-employment income, and then decide on a contribution amount that maximizes your tax deduction for the previous year, while also funding your retirement. This turns your tax extension from a simple delay into a powerful tool for building wealth and reducing your tax bill. Finally, it's important to understand the difference between a personal and a business extension. If you are a sole proprietor or a single-member LLC who reports business income on a Schedule C with your personal Form 1040, you use the same Form 4868 we've been discussing. However, if your business is structured as a partnership or an S corporation, The business itself must file a separate tax return. To extend that business return, you would use Form 7004. This is a critical distinction, so be sure to use the correct form for your situation. As you can see, for the self-employed, an extension is a vital tool for both accuracy and strategy.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.